Earnings results is upon us, and in this video I'm going to be looking at the Q2 results that are due for this week only. Starting today, we've got JP Morgan, Pepsi and Goldman Sachs. I also thought as well that I'd just add a few trading updates from the UK for people that just invest in UK shares. So we'll be looking at 888, Barrett, Dunelm, XPeria and Burberry. Burberry is quite an interesting one because just recently the CEO left and the stock did fall. It's the 13th of July. My name's Tyrone and you're watching Minipip. So for anyone that doesn't know what earnings are, it's a requirement in the United States for a public company to publish their results every quarter. In the UK you don't have to do that, but often you do need to give investor trading updates. And they're like earnings, but they're much softer in terms of data and the influences on the share price. And if we look at America, earnings happen every quarter. They are really big. They are, massive in terms of their influence on the markets. They can move share prices. They can move markets. Last quarter, I was in, I think it was Microsoft, and it went up around 7% on the day. But then you've got things like Apple, where the results was the best that they'd ever been, and the share price had fallen like 6 or 7% as well on the day, and that's just because they didn't actually give any forward guidance. But looking at this week, it's mainly banks, and banks have an influence on the Dow Jones primarily over the S&P or the Nasdaq. The Nasdaq is just tech. So if we look at the Dow Jones this week, we've got Goldman Sachs, which has a 7.1% influence on this index, and JP Morgan, which has 2.9% influence on this index. There's also United Health, which isn't a bank, it's a health insurance company in America. They're the biggest company in terms of health insurance, and they also have a 7.8% influence on this index fund. So overall, these three companies have a 17.8% influence on just the Dow Jones. But if we look at the S&P 500, they only have a 2.6% influence. So this week is going to be quite an important week for the Dow over sort of the Nasdaq and the S&P, and the Dow could break out and could go a lot higher, and I do think it's very possible. We're not overbought. There's a lot of people predicting a crash, but if these results come out and they do well, there is no reason for these markets to not go up. So first of all, I'm going to look at JP Morgan, and I'm going to go through a couple of the companies pretty quick, just look at the price targets, support and resistance, and see what levels we want to be aiming for really. So looking at JP Morgan, firstly we've got a trend that broke around the 11th of June, and we found a sort of base at 147. Now where it currently sits, best case scenario is we go back up to test that resistance, which is around 170, which I think probably won't happen. So you want to be aiming for about 165, 170. If results are poor, we've got support going down to 149. If we break that, then we could go down to that 140 level. 149 sits about there, 140 a bit lower, and that's just because you've got initial there and the highs of 2020 just before the pandemic crash, and then you've got the resistance there. So overall, JP Morgan, I think it should do quite well. One thing is that with banks is that interest rates are low, and with interest rates low, they can't charge as much on their products. But just recently, I know that the UK, it was actually today, the UK did say that British banks were allowed to resume dividends, which has boosted the FTSE just this morning. And I do think that for the long term, banks are always going to be good anyways. I know that there's crypto getting involved and things like that, so there's obviously a competitor to it as such to the banks. But given this earnings, I think that JP Morgan should be okay. Looking at Goldman Sachs, which is another influence on the index fund, the Dow Jones, we've got the same situation as JP Morgan. We broke a trendline support around the same time in June. I do probably think that it's going to have the same type of move. So we've got resistance at the highs at around 396. So we want to be aiming for that if results are good. If results are bad or they're poor, they're not as expected, you've got support all the way down to sort of that 350 level. So there's plenty of support. Now, Goldman Sachs is an investment bank. JP Morgan's more of a commercial bank where you keep your money. Goldman Sachs, they do more investments, trading, mergers, all that type of stuff. So that's probably one of the reasons why, if we actually look at both of them just quickly in comparison, we'll be able to see that from a point of view from the pandemic highs, that Goldman Sachs has done better, and that's probably because they've had a lot more investments and dealings with the markets, so therefore they've done better. Now, if I was going to pick out of either of these two, I would go with Goldman Sachs, just on the basis that it is investment related over JP Morgan. Again, that's just my personal opinion, it's not investment advice, so don't take it as that. The other stock that I wanted to look at as well was United Health Group. So United Health is the biggest influencer on the Dow Jones. It's around a 7.8% influence. And they are still in an uptrend from the pandemic low, and I don't see why that should break sort of on this week when their earnings are due. They could come down to around the 400 level. I don't see that being an issue. With it being insurance, it's a subscription sort of revenue service model, business model, and there's no reason for this to continue high. And I do think that throughout the space of the year, this will continue higher, and if this continues higher, the Dow will probably continue higher. MACD is positive, and RSI is not overbought, and it's the same when we look at the other stocks as well. We've got RSI and MACD not overbought, and when we're actually positive on MACD, and JP Morgan positive MACD, and we're not overbought again. So there is definitely room for these shares to go up. Now, looking at some other companies, we've got Pepsi. So if we just go back to the earnings calendar, which is due, it's on the NASDAQ list, so we can see what companies are due. So I'm only looking at the bigger ones. There are so many companies that are due on Tuesday, which I'm not reviewing, but if you wanted to, you could go and have a look at them. So on Tuesday, we've got Pepsi. So I'll just quickly look at Pepsi first. Pepsi is sort of the same as United Health. It's one of those where it's a product that you can always buy. So I just feel like it's a good stock to own. I'd rather have Coca-Cola, but if you do have Pepsi, we have a trend line there. There's potential that we could come back down. If earnings are poor, we could fall down to the support at around 14,000, and then potentially go up to around 16,000 within quarter three. That would be what you'd be looking for. Given that results and we're at all-times high, I think that Pepsi will probably fall. It's a bit of one of them stocks that's sort of range bound and is very slow in the way it moves, like Coca-Cola. We do have a positive MACD, and we do have RSI, which isn't overbought. MACD does look, though, like it is potentially going to roll over. Just look at that. It's positive, but it's slowing down. It's not as positive, shall we say. The momentum isn't as positive. It is a very slow moving stock, is Pepsi. So despite the earnings coming out, it's not a stock that interests me. It doesn't move enough. So going back to the earnings calendar, on Wednesday, we've got Bank of America, Wells Fargo and Citi. Again, big banks, especially Bank of America. It's one of the biggest banks out there. And if we look, they're going to be the same situation as the Goldman Sachs and JP Morgan. So we've got that influence where we've got that trend line break. So such like that. This one though, however, Citi does look a bit more negative. So there is a slight downtrend happening here. And if we do break above that on earnings, we could definitely go into 8,000 or $80 a share. If we do, then we could potentially be going down to 60 per share. But again, this wouldn't just happen overnight. It would happen over the space of the third quarter. So if results are poor, generically speaking, you would see these companies do poor for the next following quarter. So between now and September, if the results are good, then you would expect the stock to continue rising. So it's quite important if you're holding shares, because the results will make a difference in terms of the influence going forward for the next 3 months. Wells Fargo and Bank of America, so let's have a quick look at them. They'll be in the same situation. So Bank of America, Wells Fargo. Wells Fargo actually looks not too bad. They're still in the uptrend, whereas all the other banks did actually break that trend, and they're sort of they don't know whether they're testing it or not. So with Wells Fargo, there's potential that we could go up towards that 50 level in this third quarter. We get some poor results and we see a break of this trend line. We want to be aiming for around that 40 level. Overall, Wells Fargo looks pretty good. I don't have any issues there with that one. We've got Bank of America again. So let's have a look at Bank of America. Bank of America. So Bank of America, it's the same situation. I think it depends on how you see. The thing is with drawing trend lines is you're just looking at a chart and just assuming stuff. Now you could say that we've broken that trend line. You could say that we've got support. But let's say, provided that Bank of America do okay, we want to be aiming for the highs really. So we want to be aiming, if the results are good, around 42 a share. If results are bad, about 37. The problem with banks is that they just don't have that influence that you're looking for in terms of trying to get a good share price move. They'll move 3, 4, 5% maximum. You're never going to get a 20, 30, 40% increase in a month in a bank stock because they just don't work like that. One of the stocks that is doing results is Delta, and Delta's a share that I've watched quite a lot in the past, and they have just broken sort of support around 25th of June. Now, they do have a downtrend happening at the moment, and I would like to see these go up. So I would be a buyer of these anyways, because I think that eventually airlines are going to return. And I can't remember if it was Delta or I think it was United Airlines. They just did a record order for Boeings and Airbus, which tells me that an airline wouldn't take that risk if they thought that the industry wasn't going to recover. And if the industry recovers, in the long term, you want to be aiming for that 60 to 70 level, because at some point they will recover. I would be aiming for earnings. I'd be aiming for around that 47 a share. If we do really good, then it could definitely get up to that 50, 51, 52. If results are poor, then we could continue further down to around 40 per share. And if they was really bad, we could potentially even fall to around 37. I don't think that we're going to get here. I think that it's possible we could get to 40, but I would be aiming for 51 at some point in the third quarter, which is a nice increase of around sort of 10%, which is good, but it could take a while to do that. Now, looking at the earnings again on Thursday, we've got Taiwan Semiconductor. So Taiwan Semiconductor is a huge company. It's got a market cap of 600 billion. It's almost $1 trillion company, and it essentially produces a lot of the materials that go into iPhones, Samsung phones, and a lot of other. This looks good. Taiwan Semiconductor looks good, and I have a lot of. Well, I think that this is just going to do really well. So I would definitely be putting money in this one. Now, again, this is my personal opinion. So if we go back to the pandemic low, we've had this great influence here, and you can see that in the last couple of days we've broken out. So the results are good, and provided that what's important here is provided that Apple are doing record sales, Microsoft are doing record sales, all the tech companies are doing record sales, and they have to get their hardware from sort of Asian countries, and Taiwan Semiconductor is one of those companies that has that market lead, and so there is no reason why at some point this year Taiwan could definitely get back up to the highs and go further. I think it could end up at 160 a share. Looking at just the results though, if results are good, you want to be aiming for around 130. Results are poor, we've got support, and we've got support around 115. So if results are poor, you got 115, which wouldn't be a bad place to buy. If results are good, you want to be aiming for around 130 and around 140 to 160 some point the second half of the year as well. So Taiwan Semiconductor is definitely a company which has got my interest. I definitely think that it's going to go up because of the way technology is going at the moment and the demand for technology. United Health we've already looked at. Morgan Stanley is another bank. I don't think this one is actually in the list though. Let's have a look. Oh, yeah, it is. It is in the list. Okay, so Morgan Stanley is actually it's looking all right actually. So it's a bank again. We've got a support, and actually we could probably even push it back a bit further. So Morgan Stanley looks good. If earnings are good, you want to be aiming for around that 95, and if they outperform, definitely 100 a share is probably on the cards. It could even be this year. So we want to be aiming for Morgan Stanley. We want to be aiming for around 100, sort of this quarter. If results are bad, results are poor. There was a small trend line happening here, which is a bit of a dodgy trend line, but there was a sort of influence there. So you've got support around 88. So 88 is your support, with 100 as your target, which again is a nice, rise of 9%. Looking on to Friday, there isn't too much that interests me on Friday. But going back to the UK stuff, 888, Barrett, Dunelm, XPeria and Burberry. Just quickly looking at 888. So they have done really well because people have been sat at home, being bored, spare money, probably gambling. And the stock has done really well, to be fair. But now people are returning back to work. This seems to be losing its steam a bit, and there is support below at around 350. A break below 350 could definitely see 888 fall a lot further, but if they do hold support, they could definitely head up to the £5 a share, but it could take the full 6 to 9 months to do that. Overall though, 888, despite it being in a uptrend, given its industry and given the way things are going and people are returning back to work, I just don't know if it's something I would want to be putting my money in, just because with people returning to work, the demand for their platform is going to be less. Looking at Barrett, it's a property developer. I'm a big, property is booming at the moment in this country, so there's influence if we fall down to here, and then we could potentially go up there like that. Again, even though this says to October, it's unlikely that would happen by October. You'd be looking at more of a long-term uptrend, a grind higher, provided that property prices are going up. So I live on a new build site, and house prices are just, for new builds, they're going up like 20 grand, 30 grand for every phase on a property. And that, if they're going up that much, then Barrett's going to be making more money, because I know that there is a Barrett development on the site where we live, and their prices are just going up 15-20% per house every development that they do. That's going to have an influence on the share price. So again, this is something that I can actively see, and I do think that Barrett would be a good share to have in the portfolio. It gets you involved in property, or property shares anyways. We've then got Dunelm, XPeria and Burberry. So Dunelm is, again, it's a good stock. Again, it could pull back like 888 because you've got people returning to work, so they don't have the money to spend on their house, or they're not bored, they're not changing their cushions or their blankets. Looking at the share price, you potentially could be going down to around 12 per share. That's where your support sort of sits, around 12, about 12.20, 12.30. If they hold that support, or if they bounce from here, you want to be aiming for the highs at around 16. If they break 16, you want to be aiming for 18. Again, 18 would be your target for about a year. So I reckon in a year's time, there's nothing wrong to say that Dunelm could be at around 18 per share. So again, that's an okay stock to hold. Looking at Burberry, so the price did fall quite dramatically, and we have actually found a base, which is good. I do know someone that has just bought quite a bit of Burberry stock, and there is a trend as well, which I would say is holding. So, we've got a negative MACD, but it is looking to turn positive. And if that turns positive and we've got an RSI that's reading sort of 40, there is definitely a chance that this stock could go a lot further. Maybe a 20 to 30% increase over the next sort of 6 to 9 months. Again, they have a trading statement due this week. You want to be aiming for around the 23 level first. Break above 23 takes this stock to the highs at around 24. A break above 24 takes the stock to 26. I think that Burberry would recover. I think it would recover fine. And overall, there's nothing wrong with the stock. I haven't looked at the financials of it. I'm just looking at it from a technical aspect. This looks to turn positive. We've got pretty much a good setup on Burberry. So overall, I think this looks good. At some point this year, I think that we will get back to the highs for Burberry. The CEO leaving, I don't think is a reason for that share price to stay low, only unless the next CEO that's replacing the current one is really bad. But I don't think that would be the case with a company like Burberry. They would probably pick someone that's pretty good. There is a few other companies as well. I will be reporting them online on my website on Minipip. So they will be posted on Minipip on our market analysis page. So I'll be looking at these companies throughout the week as the shares develop. Another one that I'm looking at again is XPeria, similar to Spotify that I've just done, market monopoly. A lot of companies go to Experian for the data that they hold, and it is pretty precious. On the monthly time frame, this is probably going to continue higher to around 350, so 3,500 shares, £35 a share. And again, you've got MACD turning positive, trading statement due this week. It makes sense to get into these shares now. People say there's going to be a pullback. Yeah, there probably might be a pullback, but overall, I think that market sentiment is okay. There is a significant amount of money in the markets, and as well, you've got interest rates that are low. They're not going to due to be risen for, or they're not going to rise for at least another year, I don't think. So therefore, the market or getting money, should I say, is going to be cheap. So the market should stay where they are or continue higher. They could pull back if, say, the Delta variant gets bad or whatever. But overall, I think that pullbacks will be bought into, and people that say that there's going to be a huge market crash, I don't think it's going to happen, because that happened in 2020. And so if we look at trends, say if we just quickly look at the S&P 500 and we look at the way markets go, yeah, it looks overextended, but look at 2018 where we got this massive overextension in the RSI to the point where it's reading 88. We're not even close to 88 on the RSI at the moment. We are overbought, we're reading 70, but there's another 17, 18 points on the RSI. We could easily get to 5,000 before we pull back. And it's the same if we look at the sort of crash here. All right, fair enough. We was overbought, but again, if we look at where we touched 74, and we're currently reading 71. So there's even 2 or 3 points, and 2 or 3 points could be an influence of around 300 or 400 actual physical points on the index. So there is no reason for, I don't think yet, for these markets to go down. That's my personal opinion, and you might not like it, but it is what it is. And that is all for today. If you like this video, please subscribe and like the channel. We will be looking at more companies throughout the week as well, and I will be posting more videos. Thank you very much.